Hello and welcome to the UBP podcast. My name is Peter Kinsella and I'm the Global Head of Foreign Exchange Strategy at UBP. Today I'm going to be looking about sterling and indeed looking at the changing fortunes for the British pound. In my view, the Bank of England is running an increasingly risky policy setup. I think that there's now a material chance of significant sterling over the coming months. Regular readers of UBP's research will know that we've maintained a broadly constructive tone for sterling and indeed for sterling assets over the last 18 months. This view has proven to have been largely correct. Despite the plethora of bad news reports in recent years, sterling has not depreciated aggressively as many analysts had predicted. Our rationale for expecting sterling to perform relatively well was that it traded at very compelling valuations, according to the standard valuation metrics which most currency analysts use, and the decline in UK political uncertainty, in particular the avoidance of a Corbyn-led government, provided an upside catalyst for sterling gains. However, a number of recent developments have led us to question this view, and it now seems to us that there are increasing risks of material sterling weakness in the coming months. There are two main reasons for this. The first is economic, and the second is political. In February and March, the Bank of England cut rates to 0.1% from a high of 0.75%, and it restarted its quantitative easing programme by committing to purchase around £200 billion worth of UK government bonds. It also reduced the banking system's counter-cyclical capital buffer, meaning that banks had more capital to lend into the economy. Finally, it also reintroduced its funding for lending programme, which is rather similar to the ECB's TLTRO policy. These are all pretty standard measures to deal with an aggressive drop in aggregate demand, and they were largely successful following the global financial crisis in 2008 and 2009. However, recent commentary from the BOE has been concerning because the BOE is considering the introduction of negative deposit rates. Previously, the BOE was completely against this policy of charging depositors for leaving money in the banking system. The former governor of the BOE, Mark Carney, was dead set against this policy. However, institutions do not make decisions, people do, and the new people at the BOE are said to be giving the policy serious consideration. In theory, negative deposit rates are supposed to increase economic activity because investors and depositors want to avoid deposit charges and instead put their money to productive use in the economy. That's the theory. In practice, negative deposit rates have a number of side effects. It leads to further decreases in bond yields and conversely increases in bond prices because wealth managers often structure short-term bond portfolios for their clients which practically mimic cash deposits but avoid the deposit charges. Negative deposit rates have also led to a significant hit to banking sector profitability, because for the most part, retail banks have not passed on the charges to consumers and have simply taken a hit to their top-line profitability. The ECB believes that its negative rate policy has been more beneficial than many believe, and they credit the policy with leading to a decline in borrowing rates for Eurozone corporates. The ECB has also probably noted that the imposition of negative deposit rates had a detrimental effect on the external value of the euro, which declined on a trade-weighted basis following the imposition of its negative deposit rates policy in mid-2014. The ECB is not unhappy about this development. One of the main issues that we have with this policy is that it's had a pretty short gestation period. Before the global financial crisis, this was something that academics talked about in purely hypothetical terms. And yet since 2014, negative deposit rates have become a permanent policy feature of the European, Swiss, Japanese and Swedish economies. Interestingly, the Swedish central bank has since raised its deposit rate to 0%, saying that the longer-term side effects of the policy outweigh the short-term benefits. There was one other crucial point about the negative deposit rate experiment. Every country and every central bank which has implemented the policy runs large current account surpluses. In practice, a current account surplus means that these countries save more than they consume. Consequently, they already export capital to the rest of the world. This is where the problem arises for the Bank of England. The UK runs a huge current account deficit and has done so for decades. In practice, this means that the UK consumes more than it saves, and it has to borrow or get foreigners to purchase UK assets to keep the current account in balance. Therefore, If the BOE imposes negative deposit rates, it will be penalising savers in an already saving deficient economy. It sends an entirely inappropriate signal to international investors, which is that the UK doesn't want your money. And this is no small matter. The UK has always been a magnet for capital and for wealthy people all over the world who have their money managed from London. The BOE could simply hope that the banks don't pass the costs on to consumers, but then this would be self-defeating. The only effect would be to see banking system profitability decline even further. If the BOE does implement negative deposit rates, it will be seen as a test case by economists around the world. Given the risks involved, it is not a risk that any careful or prudent central bank should implement. There is the possibility that the BOE is merely jawboning and trying to keep longer dated interest rates at low levels. But we have the distinct impression that there is a real possibility that negative deposit rates could become a policy feature by the end of this summer. If this manifests itself, sterling will weaken materially. The second thing which leads us to take a more cautious stance regarding sterling is the state of EU-UK trade negotiations. Put simply, the negotiations have achieved very little. The main sticking points are that the UK does not want to abide by the rulings of the European Court of Justice on trade matters, and it wants to avoid EU rules on state aid. There is some toing and froing regarding European access of UK fishing waters, but this is more about semantics than anything else. Most of the fish caught in UK waters are exported to the EU anyway. The problem is that it is politically important for the EU and the UK due to their respective domestic political backdrops. The UK's self-imposed end of June deadline for the talks to show progress is fast approaching, and once again the EU's focus is elsewhere. When David Cameron tried to get a reduction in EU migration towards the UK, most of the EU's attention was on the sovereign debt crisis and then on the migration crisis. Put simply, the UK's concerns were not the primary concerns of the EU, and it resulted in a lack of flexibility shown towards David Cameron when they needed, and which then subsequently ended up in Brexit. Talk about the laws of unintended consequences. This time around, most of Europe has moved on from Brexit, and it no longer generates significant headlines, especially in continental Europe. At the moment, the EU is dealing with the economic fallout from COVID-19 and also taking tentative steps towards dealing with COVID-19 related debts on a mutual aid basis. In time, this could be seen as the first tentative steps to becoming a transfer union. But nonetheless, European capitals have enough on their plate, and they will not be in any mood to placate the demands of the UK. In effect, this means that there is at least a 50-50 chance that the EU and the UK do not achieve a trade agreement by the end of the year. Consequently, the UK may end up reverting to World Trade Organization rules by the 1st of January 2021. Eventually, the EU and the UK will come to a trade agreement, so it is a case of being no deal for now rather than no deal forever. But in the meantime, sterling will be the most obvious victim of the UK's negotiation stance. The bottom line for us is that the broader economic and political context has changed, and consequently sterling is clearly at risk of material declines. Thank you very much for listening. We wish you all a very good day.